To our talk of the tape. Is all this churn just about an overheated market cooling off a bit after a rapid sprint higher, or is it the start of what would be the first notable broad pullback in some 5 months? We pose this question to Malcolm Ethridge, CIC Wealth Executive Vice President, and a CNBC contributor. Malcolm, good to see you. Welcome.
Yeah, good to be here.
We're up 16 of 19 weeks in the S&P. Haven't had a 2% pullback on a closing basis in one of the longest stretches in history, which leads you to say, okay, we're due for some chop. On the other hand, there's the argument to be made that a little more payback, maybe on a valuation front, maybe sentiment, and even who knows about what's happening with rates. So how are you viewing the market action recently?
Yeah, I'm wondering if investors aren't starting to realize that it's not a foregone conclusion that Powell is looking at June and saying that's where the magic happens, right? I think that maybe it's finally starting to sink in that when he says we're going to be patient here, we're going to stay higher for longer, we're maybe starting to see that filter through the markets just a little bit.
Even if that were the case, I guess I could counter that by saying, well, in January, people thought it was going to be March. He kicked that out from March into the spring or summer.
Yep.
Market took it. It was fine. The economies look like it's holding up. Earnings turned higher. In other words, how make or break is a June rate cut or one soon thereafter for the market at this point?
I would say it's at least make or break for the small and mid caps. If you just consider the small cap index, the Russell 2000 is down this week. It was roaring pretty loudly, right, the last couple of weeks.
Yeah.
We heard the broadening is happening. The broadening is here. IWM was getting bought up left and right. And now here we are. The stocks leading the way are 5 mega cap stocks. The Russell is nowhere to be found.
Yeah, we had this little bout of outperformance by the average stock, whether it's the equal weight index of the S&P or the Russell 2000, and then it's sort of rolled again. That's been fitful. It's been tough to have that take hold. We know that, and rates seem to matter for that. The other thing that seems to matter, and I keep pointing this out, but Supermicro, right? This kind of moonshot tech hardware company, this big AI play, all of a sudden was the largest holding in the Russell 2000 for a while now.
Yep.
Really big relative to MicroStrategy, crypto play, another one. Supermicro is going in the S&P at the close today. Now, it doesn't come out of the Russell 2000 right away, but the point is the Russell today what we thought it was in terms of its message?
Well, I didn't really think it was anything to be excited about yet, simply because we don't know where we're going on rates. If you consider half the companies inside the Russell aren't profitable, that means they really are impacted by interest rates, right? Every 0.25% turn the Fed has made the last couple of years has really mattered to the small caps. And so to ignore that and say, we can have a 50% run in small caps, for example, I think it's just putting the cart way out too far in front of the horse. And what we're now seeing potentially is this reversion back to mega caps and also a reversion back to mega cap tech, because we really have 5 companies that are leading the S&P right now today.
We've got 5, and on a given day, it's not always the same 5. So I think there's been a lot of difference. Yesterday, Microsoft up big, new high. Today, down a couple of percent. It just seems to be a lot of shuffling around of the deck.
But the two that matter are what? NVIDIA and Meta, right? 80% up, 40% up, respectively, right? So those two are half of the 8% return we've seen in the S&P. It's starting to be deja vu all over again, right? It sounds exactly like, last year where we came into 2024 saying a broadening is coming, things will change.
Yeah, we saw it in last summer up into the June market high, and then, of course, in the fourth quarter until it gave way. Let's bring in CNBC contributor Shannon Saccocia of NB Private Wealth to join the conversation. Shannon, your thoughts on all this, because there's a case to be made that even though those handful of stocks have contributed an enormous amount to the overall index gain, it's not happening at the complete expense of everything else, right? We keep pointing out, consumer cyclical's done okay until recently. Industrial's done okay. How, as an investor, are you thinking about the risk reward outside the big ones?
Well, one of the things that we look at, Mike, is that in this period over the course of the last several weeks, we've really been in a pretty much a vacuum in terms of micro data. Admittedly, we've had some earnings reports, Adobe notably reported today. But when we sort of shift from micro to macro, that's where, people get a little bit anxious. And I think that when you're looking at it from the underlying earnings perspective, when you're thinking about the broadening out is really going to be driven by two things. It's by improving gross margins, which are going to improve the potential for earnings growth. And it's also going to be the potential for multiple expansion. Unfortunately, some of these stocks have the vulnerability, if you will, for multiple compression. We're not seeing that in this period because people are going back to mega cap tech, over the course of the last couple of days because they're looking at the macro data and they're just not sure what it's telling them about the outlook. And so from my perspective, the way we look at it at Neuberger Berman is that looking back on the fundamentals, looking at the earnings potential, looking at the opportunity to potentially see earnings growth out of the broader part of the market, it doesn't mean that these technology companies can't grow their earnings and that they're not going to continue to, but is the premium that's been attributed to them justified from a multiple perspective, or are there ways that you can start to put some of that cash that you may have on the sidelines to work in the equity market and things that are modestly more attractive?
I mean, I guess the question then, Shannon, is do we have an economy that's going to underwrite, so to speak, the earnings growth expectations that are now getting baked in, arguably, at least into forecasts, if not into valuations?
It would appear that we still have the support for that, at least if I look at sort of the underlying and the way we're looking at things like PMI data. Sure, we're not as strong as we could be, but I would say that if we were significantly stronger in terms of the go-forward outlook for the next 6 to 9 months, that really could potentially take the Fed off the table. And I do believe that the Fed needs to move here. I think that despite the fact that when we look at financial conditions, maybe they're not as restrictive as they should be given the increase in rates that we've had, but they are restrictive in parts of the economy. And if that starts to spread, that restrictiveness in credit for small, medium-sized businesses, the restrictiveness that we're seeing in the lower income consumer, that could derail, this economic growth. So I think that if we were too hot, we'd take the Fed off the table, and this really creates a scenario for them to stay in the game.
So, Malcolm, if you think that maybe the broadening trade is not something you want to bet on in a big way, and, we narrow this sort of leadership, maybe you don't have the valuation support, do you think that you would want to become broadly defensive? Do you feel like we have to get hedged out? Is this rally on a shakier ground than the charts would make it seem?
Yeah, so I'm concerned that this is similar again to last year where we didn't think the market was going to perform nearly as well as it did. ChatGPT shows up and changes things a little bit. NVIDIA is going in a similar direction this year. It's taken the market by storm in a way that's making me say you don't necessarily want to be sitting out of this market waiting on it to start raining, right? And so I think maybe it's the time to be looking at sectors of the market that you feel are strong and, dare I say, maybe even recession-proof, like potentially cybersecurity. That's one that I love. That I feel like cybersecurity spending for at least large enterprises and government agencies is non-discretionary at this point, right? So maybe we got a little bit of conflicting data out of Palo Alto and CrowdStrike. One's having the time of their lives and the other one is telling us prepare for a storm. But I think cybersecurity is a place that you could go that irrespective of what direction the market decides to move, by the end of this year, it's probably going to hold up pretty well.
Not specifically cybersecurity, but software in general is actually under a lot of pressure today. That Adobe softer guidance has been an issue. You're seeing things like ServiceNow and other software companies suffer as well. You own Adobe. Do you think it's a change in the story? They're now getting recast in a way as a company that might be not quite positioned well for the AI world.
Yeah, so I wish that I had waited a little bit to buy it, frankly. I thought I was buying the dip when I initially got into it. I would love to step in and buy it now, but I think it's probably going to fall a little bit more simply because the news is going to continue to shake out there. I think, to your point, the concerns over their text-to-image competitors from OpenAI, for example, I think are a little bit overblown, right? Adobe has a pretty decent moat, and if you consider the fact that their tools are proprietary. All of the images that they use, their cache of images, are all proprietary to them. And they've also stepped out there and said, we're going to indemnify any of our large enterprise clients against lawsuits over copyright infringement and such. And so I think that it's probably a little bit overblown, but am I willing to be patient if I want to deploy new capital today and go into Adobe? Maybe not.
Yeah, well, it's interesting how at some point down the road we might be dealing with these companies that are saying, look, AI tools need not be a free-for-all. You don't want to necessarily kind of just throw open with whatever open source thing you have. Shannon, just give you a little bit of the last word here as to whether you think you would be looking to either build cash or just wait to do some buying, or in terms of waiting for some kind of a pullback broadly in the market, or is it kind of business as usual?
From our perspective, we believe that investors are sitting on probably outsized positions in cash, Mike. And, I think there's this argument, and you and I have discussed this previously, whether this goes into longer duration bonds or whether it goes into the equity market. I think, you just need to look at longer term allocations, and many investors are positioned less aggressively than they were, say, 12 or 18 months ago, because cash is an option. So, our belief is that cash rates are going to come down. We believe the Fed is going to hike. And, if you wait until that second rate cut, then you've likely missed some of the move there. And so I think, being prescriptive and thinking about where to add exposure based on your long-term view is really what you should be thinking about right now.
All right, Shannon, Malcolm, appreciate it. Have a great weekend.